Friends, thank you for being here today. What if I told you that the bedrock of American middle class wealth is rapidly eroding, with 53% of homes in the country losing value in just the last 12 months? And could it be that the widespread hope for lower interest rates to save the day is actually a dangerous delusion masking a much deeper economic rot? To understand where we are today, we first have to talk about the shattering of the valuation illusion. For the better part of 3 years, the American housing market has existed in a state of suspended animation, a standoff between sellers clinging to record high valuations and buyers paralyzed by the twin pressures of exorbitant prices and volatile interest rates. However, as we approach the end of 2025, the stalemate has broken. According to the latest research report from Zillow, a fundamental shift has occurred, one that marks the beginning of a significant and potentially prolonged correction. The data is stark and undeniable. 53% of homes in the United States have lost value over the last year. This statistic is not merely a minor fluctuation, it represents the highest share of homes losing value since April of 2012, a period associated with the very bottom of the last great housing bust. While the national narrative has often focused on the resilience of home prices, suggesting they are immune to gravity, the underlying data reveals a spreading decay. Among those homes that are losing value, the decline is not negligible. Zillow reports that the average drawdown is approximately 9.7% from the peak. This suggests that for more than half the country, the equity that homeowners believed was locked in stone is beginning to evaporate. This downturn comes as a shock to the general public, largely because the prevailing wisdom from real estate agents and mainstream economists has been that a housing crash was impossible due to a structural lack of supply. They argued that homeowners locked into 3% mortgage rates would never sell, thereby keeping inventory permanently low and prices permanently high. Yet, the data proves this theory wrong. The market has reached an inflection point where the sheer weight of unaffordability, combined with a deteriorating macroeconomic landscape, is forcing values down despite the so-called lock-in effect. It is important to contextualize this decline. While home values are indeed still near record levels on a national basis, inflation-adjusted home prices are over 80% above their long-term 100-year average. The trend has undeniably reversed. The market is witnessing a bifurcation where nominal prices remain high in headline data, but realized values for the majority of homes are bleeding out. This creates a psychological trap for sellers. Currently, only about 4.1% of homes have lost value since their last sale. This indicates that while the market value is dropping, sellers are digging in their heels, refusing to accept losses, and essentially freezing the market. They are looking at their Zestimate or appraisal from 2022 and believing that wealth still exists. But as the Zillow data confirms, for 53% of the inventory, that wealth is gone. Now, many people believed lower rates would save the market, but let's examine the fallacy of the interest rate savior. A central pillar of the bullish argument for housing has been the belief that the Federal Reserve holds the cure. The narrative was simple. Once the Fed begins cutting interest rates, mortgage rates will plummet, buyer demand will surge, and the housing boom will resume. This expectation has been thoroughly dismantled by the reality of late 2025. The Federal Reserve has indeed begun to cut rates, yet the housing market has not responded with a rally. Instead, it has continued to sink. This disconnect highlights a critical misunderstanding of how mortgage rates and the economy interact. Mortgage rates have not fallen in a straight line with the Fed's cuts. In fact, they have largely moved sideways or even ticked higher, hovering between 6 and 7%. This is because long term bond markets, which dictate mortgage rates, are reacting to fears of inflation, government debt issuance, and a banking system that is increasingly risk averse. Major corporations are beginning to admit that the lower rates will fix it. Theory was a mirage. In recent earnings calls, executives from Home Depot and major home builders expressed surprise that lower interest rates have had zero positive impact on sales. The chief financial officer of Home Depot noted that they anticipated rate cuts would stimulate renovation and housing activity, but that stimulus never arrived. This failure of interest rate policy to reignite the market serves as compelling corroboration that the primary problem in the United States economy is no longer the cost of borrowing, but the fundamentals of the borrower. It is a crisis of income and employment, not just interest rates. Even if rates were to drop to 5% tomorrow, the mathematical reality is that the median American household cannot afford the median American home. The affordability gap is so wide that minor adjustments in the cost of debt are insufficient to bridge it. Furthermore, banks are tightening their lending standards. They are seeing the cracks in the economy, rising credit card defaults, auto loan delinquencies, and the early signs of mortgage stress, and they are becoming unwilling to lend to anyone but the most pristine borrowers. The era of easy credit is over, regardless of what the Federal Reserve does with the overnight rate. While buyers pull back, we are seeing a massive shift in supply, specifically the inventory surge and the builder's dilemma. If demand is collapsing due to affordability, supply is exploding due to a combination of new construction and a backlog of existing homes. According to data from Realtor.com, there are now over 1,100,000 active listings on the United States housing market. This represents a 15% increase year over year and brings inventory levels back to where they were in 2019. While a return to 2019 levels might sound like a return to normal, the context is entirely different. In 2019, buyer demand was healthy. Today, mortgage purchase applications are approximately 30% below pre-pandemic levels. We have pre-pandemic supply colliding with recession-level demand. This imbalance is causing the months of supply metric to skyrocket, which is the surest leading indicator of future price declines. The situation is most acute in the new construction sector. Home builders are currently sitting on the largest inventory overhang since 2009. Unlike individual homeowners who can stubbornly refuse to sell if they don't get their desired price, builders have carrying costs and loans to service. They do not have the luxury of waiting. They must move inventory to survive. As a result, builders have become the primary source of deflation in the market. 41% of builders reported cutting prices in November, the first time this measure has exceeded 40% in this cycle. Builders are offering massive incentives, rate buy downs, and aggressive price cuts to offload homes. This undercuts existing homeowners who are trying to sell. If a buyer can purchase a brand new home with a warranty and a builder subsidized mortgage rate for less than a comparable existing home down the street, the choice is obvious. This dynamic is putting immense downward pressure on the resale market. forcing individual sellers to compete in a race to the bottom that they are psychologically unprepared for. And it's not just builders. We are also witnessing an investor exodus and a rising shadow inventory. Adding fuel to the inventory fire is the capitulation of the investor class. During the pandemic boom, the housing market was flooded with speculative capital. Institutional investors, mom and pop landlords, and aspiring Airbnb moguls bought up properties with the expectation of perpetual appreciation and easy passive income. That thesis has now inverted. Short-term rental markets are facing a reckoning. In cities like Austin, Nashville, and vast swathes of Florida, the Airbnb bust is real. Oversupply of short-term rentals has driven daily rates down, while the costs of ownership, cleaning fees, utilities, taxes, and insurance have surged. Many of these amateur investors purchased properties using debt service coverage ratio loans or variable rate financing, assuming that high rental income would cover the debt. Now, facing negative cash flow, they are being forced to sell. This is not limited to amateurs. Large institutional investors are shifting from being net buyers to net sellers. Major firms that hoovered up thousands of single family homes in 2021 and 2022 are now quietly offloading portfolios. They are letting leases expire and putting homes on the market, particularly in the Sunbelt states where values are falling fastest. There is also a hidden layer of distress known as shadow inventory. This includes homes that are in the foreclosure process but have not yet hit the market, as well as homes that were listed and then rage delisted by sellers who refuse to accept lower offers. These sellers are not staying in their homes because they want to, they are trapped. As the economic screws tighten, these shadow listings will eventually be forced back onto the market, likely at much lower prices, further exacerbating the supply glut. But housing is just one piece of the puzzle. The real concern is that the macroeconomic engine is stalling, specifically regarding jobs and incomes. The housing market does not exist in a vacuum. It is a derivative of the broader economy. And the broader economy is flashing warning signs that are far more severe than a simple cyclical slowdown. The narrative has shifted from fears of inflation to fears of employment. The labor market is deteriorating in a specific and dangerous way. While headline unemployment numbers have risen slowly to around 4.4%, the details reveal a white-collar recession. Unemployment among workers with four-year college degrees has reached record highs relative to the total unemployed population, now comprising 25% of the total. This is a sharp departure from typical recessions, which usually hit blue-collar workers first. This time, the slowdown is driven by cost cutting in the technology, finance, and professional services sectors, the very industries that employ the people who can afford today's median home prices. We are seeing a structural shift where companies are using artificial intelligence and automation to eliminate entry-level and mid-level white-collar roles. Corporate America is in survival mode, slashing headcount to preserve margins as consumer demand wanes. The data supports this grim outlook. Revisions to federal jobs reports have consistently wiped out previously reported gains. Federal Reserve Governor Christopher Waller has suggested that employment likely fell in absolute terms between May and August of 2025, a contraction that was masked by seasonal adjustments. Furthermore, impending mass layoffs surged in October to one of the highest levels in 20 years. This weakening labor market creates a vicious feedback loop with the housing market. As home values fall, the wealth effect reverses. Consumers who feel poorer because their estimate is down and their job is insecure pull back on spending. We see this in the retail sector where discretionary spending is collapsing. Shoppers are migrating from Target to Walmart and from Walmart to dollar stores. This reduction in consumption leads to lower corporate earnings, which leads to more layoffs, which leads to more forced home sales. It is a classic deflationary spiral that is just beginning to gain momentum as we head into 2026. Even if you have a job, you still have to contend with the crisis of affordability and the insurance black swan. Even if a potential buyer has a job and a down payment, the total cost of home ownership has become a nearly insurmountable barrier. It is not just the mortgage principal and interest. It is the hidden costs of taxes, insurance, and maintenance that are crushing affordability. The insurance market is in a state of collapse in key states. In Florida and California, major insurers are exiting the market entirely, leaving homeowners with few options other than state-run insurers of last resort, which offer minimal coverage at astronomical premiums. In some areas, the cost of insurance has tripled or quadrupled in just a few years. For a buyer stretching to afford a monthly payment, an extra $500 a month in insurance premiums is a deal breaker. Worse, if a home cannot be insured, it cannot be mortgaged. This forces these properties into the cash-only market, drastically reducing the pool of potential buyers and slashing the property's value. Simultaneously, property taxes are rising as municipalities face their own budget crises. With commercial real estate values plummeting, leaving office towers empty and generating less tax revenue, cities are shifting the tax burden to residential homeowners. Utilities are another rising cost. The explosive growth of data centers to support artificial intelligence is straining the nation's power grid, driving up electricity costs for residential customers. In some regions, homeowners are facing double-digit percentage increases in their electric bills. When you combine these factors, the income required to maintain a home has detached from reality. Analysts estimate that for the housing market to normalize to historical price to income ratios, home prices would need to fall by anywhere from 38% to 50%. Alternatively, incomes would need to double, which is highly unlikely in a softening labor market. The gap must close, and history suggests it closes through lower asset prices, not rapidly rising wages. Now, this crash isn't happening everywhere at once. What we are seeing is a tale of two markets with significant geographic and asset bifurcation. The unfolding crash is not affecting every square mile of America equally. We are witnessing a bifurcated market where specific regions and asset classes are imploding while others hold steady for now. The ground zero of the correction is the Sun Belt. States that saw the greatest influx of migration and speculation during the pandemic, Florida, Texas, Tennessee, Arizona, and the inland regions of California, are now leading the downturn. In Texas, inventory has ballooned to over 134,000 homes, levels not seen in over a decade. In Tennessee, inventory is 50% higher than the long-term average. Florida stands out as the most troubled market in the nation. The combination of the insurance crisis, an oversupply of condos, and the reversal of pandemic migration trends has created a perfect storm. Condo values in Florida are down 9.9% in the last 12 months, the sharpest decline since the 2009 bust. The condo market often acts as the canary in the coal mine for the broader housing market, because condos are typically the first assets investors dump when trouble arises. Conversely, markets in the Northeast and Midwest, such as New York, Connecticut, and Pennsylvania, are seeing slight value increases. These markets did not experience the same degree of speculative overheating as the Sun Belt, and they are currently protected by a structural lack of inventory. However, even in these resilient markets, the volume of transactions is low and the cracks are forming. There is also a bifurcation between price points. The high end of the market is currently sustained by cash rich buyers and the wealth effect from the stock market. However, the entry level and mid tier markets are frozen. As the stock market begins to wobble, threatened by the concentration of risk in AI stocks and the general economic slowdown, the support for the luxury market is fragile. If the stock market corrects, the high end housing market will likely follow the low end into negative territory. So, what comes next? The outlook for 2026 suggests we are entering the great unwind. As we look toward 2026, the consensus among independent analysts is that the slow bleed of 2025 will accelerate into a more chaotic correction. While the National Association of Realtors is predicting a rebound with double digit sales growth and rising prices, their track record suggests extreme caution. They predicted a similar rebound in 2007, just before the global financial crisis. The more data driven forecast suggests that 2026 will be the year the wheels come off. The temporary factors that have propped up the market stimulus savings, the lock in effect, and investor optimism have been exhausted. We are entering a phase where the market must find its natural floor unassisted by government intervention or cheap money. A major demographic force known as the silver tsunami is beginning to make landfall. Baby boomers, who own a massive percentage of the nation's housing wealth, are aging. As this generation moves into assisted living, downsizes, or passes away, their homes will hit the market. This is not a short term wave, but a 20-year structural increase in supply. Unlike institutional investors who watch every penny, heirs who inherit these homes often prioritize a quick sale over maximizing price. They are price indifferent sellers who will accept the market clearing price to liquidate the asset and split the cash. This will add a consistent, long term source of inventory that will cap any potential price appreciation for years to come. The prediction is that home prices will continue to grind lower, potentially falling for several consecutive years until affordability is restored. This correction could be worse than 2008 in terms of the duration and the depth of the valuation reset required. In 2008, Wall Street stepped in to buy the dip, putting a floor under prices. Today, Wall Street is a net seller. There is no white knight coming to rescue the market this time. The government may attempt to intervene with programs to assist buyers, but given the scale of the debt and the inflation risk, their firepower is limited. As financial reality sets in, we are already seeing deep signs of desperation and adaptation in how Americans live. As the crisis deepens, we are already seeing signs of desperation in how Americans live. The American dream of a single family home with a white picket fence is being retrofitted for survival. In neighborhoods across the country, homeowners are subdividing properties, converting garages into rental units, and parking recreational vehicles in driveways to generate extra income or house displaced family members. We are seeing the rise of multi generational households, not by choice, but by necessity. Adult children are moving back in with parents, and aging parents are moving in with children. In some extreme cases in high cost areas, we are seeing pad splits where a single family home is divided into sleeping quarters for 8 or 10 unrelated adults. This tenementization of the suburbs is a grim indicator of just how broken the housing market has become. This desperation is also evident in the financial behavior of homeowners. Many are tapping into their home equity lines of credit to pay for groceries and basic living expenses, eating away at the very equity they are trying to protect. This increases the risk of foreclosure when the inevitable job loss occurs, as these homeowners have removed their financial buffer. But perhaps the most dangerous aspect is the systemic paralysis driven by credit contraction and economic calcification. Beyond the visible distress of price cuts and for sale signs lies a more profound and structural consequence of the housing downturn. The paralysis of the broader American economy. The housing market has historically functioned as the lubricant for the United States labor market, allowing workers to move freely to where opportunities exist. That mechanism is now broken. We are witnessing the solidification of a locked in society where the combination of negative equity and the gap between current mortgage rates and the historic lows of the pandemic era has created golden handcuffs for millions of households. This immobility creates a sclerotic labor market in a healthy economy. A worker in a declining market like Florida who is offered a better job in a growing market would simply sell their home and move. Today, that worker is likely underwater on their mortgage or unwilling to trade a 3% interest rate for a 7% one. The result is that they decline the job offer and remain in a location with diminishing economic prospects. This friction reduces overall economic dynamism, lowers productivity, and deepens the recessionary forces at play. We are creating a zombie workforce attached to zombie properties, unable to pivot as the economy shifts. Furthermore, the contagion is spreading rapidly into the banking sector, specifically threatening the stability of small and mid-sized regional banks. These institutions are heavily exposed to both residential real estate and commercial real estate. As home values decline, mirroring the collapse already seen in the office sector, the collateral backing trillions of dollars in loans is deteriorating. Banks, sensing this erosion of value, are reacting by hoarding capital and aggressively tightening credit standards. This is the classic credit crunch dynamic. It is not just about mortgages, it is about small business loans, construction loans, and personal lines of credit. The era of the home as an ATM has abruptly ended. For the past decade, American consumer spending was partially fueled by home equity lines of credit or HELOCs. Homeowners used rising paper wealth to fund renovations, start small businesses, or consolidate high interest debt. With values falling and banks terrified of risk, these credit lines are being frozen or slashed. This drains a massive source of liquidity from the consumer economy exactly when it is needed most. Small businesses, which often rely on the owner's home equity for initial capitalization, are finding themselves cut off from funding. This stifles entrepreneurship and job creation, feeding back into the white-collar recession discussed earlier. Ultimately, this creates a doom loop of economic calcification. Falling home prices lead to reduced consumer spending and bank lending. Reduced lending leads to business failures and job losses. Job losses lead to more forced home sales and foreclosures, which drive home prices down further. This systemic paralysis suggests that the housing correction is not merely a sectoral adjustment, but a macroeconomic anchor that will weigh down United States GDP growth for years. The transition from an asset based economy where wealth is generated by owning things back to a production based economy where wealth is generated by making things will be a painful, volatile, and lengthy process that will redefine the American financial landscape for a generation. Ultimately, what we are watching is an inevitable return to fundamentals. The United States housing market is in the early stages of a historic correction. The 53% of homes losing value in 2025 is just the opening act. The convergence of record high inventory, a weakening labor market, an insurance crisis, and the retreat of speculative capital has created a downward spiral that is self reinforcing. For potential buyers, the message is one of patience. The market is moving in your favor, but it moves slowly. The fear of missing out that drove the mania of 2021 has been replaced by the fear of buying at the top. Cash is king in this environment. Those who can preserve their capital and wait for the distress to work its way through the system will likely find generational buying opportunities in 2026 and 2027. For sellers, the window of opportunity is closing, and for many, it has already shut. The days of multiple offers over asking price are gone. The new reality is price cuts, concessions, and competition with desperate builders. Ultimately, the market must normalize. An economy cannot function when the average worker cannot afford the average home. The correction we are witnessing is the painful but necessary mechanism by which that balance is restored. It is not a glitch, it is gravity reasserting itself after years of artificial levitation. The illusion of perpetual wealth creation through housing is shattering, and the reality of a changing economic order is taking its place. The year 2026 promises to be a year of volatility, distress, and eventually a return to financial reality.